a quick intro about myself, who I am, and how I might be able to help some of you guys out. So, as you might have heard before, I'm a high school science teacher going on 16 years now. Before I was a science teacher, I was a financial advisor for Ameriprise. So I took my Series 7 insurance, all those licensing tests as well. And I was helping some people with money management, just personal finance. But a lot of that had to do with getting people into some very high expense ratio ETFs and mutual funds. This was back in like the early 2000s. And then I realized that that job was mostly a sales job. It wasn't really helping out a lot of people. So decided to be a science teacher at that point. And as I've been teaching science, I saw a lot of other teachers that were looking for just financial help as well. I would do simple things like set them up in their Roth IRA, just do basic, mutual funds of target retirement funds, how to go over a budget, things like that. But then I was looking more into options because I did learn a lot about options when I passed my Series 7 exam. So by doing that, I noticed that you could pretty much decide what type of option you want to use with certain parameters where sometimes it could be a very high risk trade, but in other situations, if you set them up right, they could be a relatively low risk trade with pretty decent returns. So I do have a presentation ready. I'm going to share my screen real quick.
Cool.
Russell, could you enable that, please?
Oh,
It says host disabled.
okay. I've done this once before.
I'll keep talking while you try to figure that part out.
Advanced sharing options. Let's see.
So,
They're all participants. Okay.
I think I got it.
There we go. That should work.
All right. I can't see the chat right now, but if someone in the chat could just let me know quickly. Do you see a PowerPoint popped up?
I can see it. And I can see the chat as well. So I'll see if anybody responds.
Okay, great.
Let's see.
I'm gonna lower that.
Omesh says yes.
All right. So I wanted to go over. Okay, great. Thank you. So I want to go over today just the basics on what an option is, why I recommend selling options instead of necessarily buying options, although there are situations where you do want to buy options back where you can lock in profits. So I'm going to do a quick 5 or so minute intro on what options are in terms of buying and selling them with calls and puts. There is a lot more information I could discuss on that, but just for brevity's sake, I want to do that relatively quickly and then go over some situations on why I recommend selling options. So why sell options? They are a way to earn income via the premium collected. So when you see an option, essentially, let's go call options first, you're agreeing to sell 100 shares of a certain stock and then receive a certain premium for it. So let's imagine that you're in a casino. Those casinos, they keep getting bigger and bigger. You don't see a lot of casinos going bankrupt, right?
Yep.
Casinos have a slight edge in the odds that they're doing in their bets, right? If you're playing a roulette wheel and you bet on black, it's not quite 50-50 odds. They have those green zero, green double zeros, which makes the odds slightly in the casino's favor. So if you bet on black 50 bucks and then it's black, you'll be at 100. But because of that zero and double zero, you're not going to be quite at 50-50. I think it's somewhere around 48 point something percent. So when you're looking at an option, you could either buy the option or sell the option. And I want to look for situations where I'm kind of like the casino. I'm going to take bets on stock that are not going to reach a certain price, and then you're going to make money on the bet. So the way that I imagine this, let's say that there's a stock that's exactly $30 a share. What you could do is sell a call option, for instance, saying, I don't think it's going to go up past $40 a share. No, it's a pretty big jump from 30 to 40. And the odds of it happening aren't relatively low. There are going to be some people that are going to decide, man, maybe I'm going to take that bet because I think that stock's going to go to 60, 70. They could buy a call option in order to use a smaller amount of money than buying shares. And then if the stock goes up to 70, 80 or so, they can make a huge amount of money. However, the odds of this happening are relatively low.
Right.
So what you're gonna do is be the seller of that option, okay? In general, most options do expire worthless. Selling options can have a high probability of success. If you make very dramatic differences from where the stock price is to where your bet is, there's a very low chance of this particular bet being a loss, okay? And as you guys have questions on this, leave it in the chat. I want to go through all this first and then we'll get to the questions, okay? So quickly, let's go over puts and calls. I like starting on a put side. Now, the cash secured put means you have cash available in your brokerage. You're securing the position with the money that you're leaving in your brokerage account, and then you're going to make a put option. So cash secured put is when you're agreeing to buy 100 shares of a stock if it reaches a certain price called the strike price. Now, for the puts, those are lower. For instance, from before, if the stock's at 30 and then you're buying a put for 25, you're thinking that the stock's going to completely tank down to the teens, and then you can make a good amount of money on it. Okay. A cash secured put is the opposite end. However, that's when you are selling an option. So it's a good way to own a stock at a cheaper price than the current price, and you can get paid to wait. So here's an example I looked at last month. I started with a relatively stable stock, BAC, Bank of America. In June 28th, last month, the stock was priced at $41.56. Now let's say you want to buy this stock, you like the stock, you think it's going to be a good value, but you think it's a little too expensive, okay? Instead of buying shares BAC, you could sell a cash secured put. You notice you're selling it, you're not buying the put. And let's put a strike price a little bit below the 41.56. We're going to sell a cash secured put at 40. And then at the time of doing this, this was a month out. So for July 30th, you would earn 0.68. And whenever you're looking at options, you multiply by 100. So you'd be receiving $68 in premium for this side bet that you're essentially making. Okay.
Right.
So what are the benefits and kind of consequences to this? If the stock tanks to 10, you will have to buy the shares at 40. You're making that agreement when you are selling the put. Okay. That is one of the main consequences to certain options, especially if it tanks.
And that's what cash secured means,
So,
right? Yeah, so cash secured just means that you
yes.
have to put that money aside in the event that it goes wrong. So I was a bit confused starting this. I thought cash secured, what the hell, but that's all that means, right? Just
Okay.
making sure it's clear.
Yeah, that was the next sentence I wrote. So
Oh,
if
right.
you're going to do
So-
a cash secured 40, you need to do $4,000. It's 40 times 100 shares. So you have to leave $4,000 in your brokerage account. Because if the stock goes way lower to say $10, you do have to buy it at 40. And then your brokers would take $4,000 out of your brokerage account to buy the shares. Does that help a little bit on the clarification for that?
Sounds good.
Okay, now let's say there's a few situations that could happen with this stock by July 30th. Let's say the stock ends higher than 40. In this case, the option will be considered worthless, because why would you want to buy shares at a higher price when you don't have to? So in this case, you could earn the $68 in premium. This premium, by the way, when you set up the position, you get immediately. So you could have done this on 628, get $68 right off the bat. You could go play with your kids if you want that. They'll spend it all on Roblox anyway. Now, how do you figure out the return on your investment? So you're collecting $68 in premium. Let's say the stock hovers around 40 but ends at $42 or so. The option will expire worthless, but you're keeping that $68. You could divide that by the $40 in your strike price. When you divide 68 by 40, you're receiving a 1.7% return in just a month time. In the end of the 730, this $4,000 you could use again for a different position if you want. Okay. Now there are some other situations. So let's say the stock closed at 42, same thing I just said, you keep your $68, you can use that 4,000 again, okay? If the stock closes slightly above your $40 strike price, so $40 and a penny, that's the exact same thing as before. You keep your $68. You made the bet with somebody, you have them to win your bet, and then you could just use that 4,000 for something else. Now here is one of the negatives, but I'm gonna go over where it's not necessarily that bad of a negative. Let's say the stock does close at 39. You will have to buy 100 shares of Bank of America at 40. That's what you did in your cash secured put agreement. And then if you want to think about it this way, you got a discount from the original 41.56. You saved 1.56 times 100 shares. You actually saved $156 for owning this particular company. And as always, you keep that $68 in premium. I kind of like to look at the glass half full a little bit. You got a little discount on your shares. You got paid to get that discount. So this is a good situation. A lot of retirees, some people that want to be relatively conservative, do this quite a bit with relatively stable stocks that don't fluctuate a lot in price. Now, Russell, any others have any general questions about cash secured puts?
No, I think that's pretty much covers the basics, right? I mean, the idea is it's very safe, a very high win rate, because if you can pick the right situations, then you're going to win nine out of 10 times sometimes. But you won't get a lot of money per win, but you'll win, which is important, right? It's kind of the way I look at it.
Right. Right.
Yeah.
We're going for singles and doubles in baseball. We're not trying to go for home runs here, but some of those World Series winning teams, they just keep hitting singles, doubles over and over, and it's too hard for the other team to get back at you, right?
Yeah.
Here's some of the downsides. If your stock does decrease significantly, you could lose more money than that premium received. And I'll explain what you could do. There's two different strategies you could do when this happens. Sometimes you will, you'll always have to wait a period of time for the option to expire. Let's say I typically like 30 days out of monthly options. You could go up to 45 days and still get a lot of the benefits. Some people even do weekly options, but that is a downside. You have to wait for the position to exit. Now, there is a flip side to cash secured puts. Can you sell options on shares that you already own? Yes. Now, this could be a good one for some of you guys listening in. If you happen to already have 100 shares of a stock, what I see a lot of beginners or some people do is if they own shares, 100 shares or so, they don't particularly want the stock anymore and they just simply sell it. There's another strategy you could actually do that could bring in income every week, every month, whatever you decide. Essentially, you could rent these shares out to someone, and this is called a covered call. A call is essentially agreeing to sell the shares at an agreed upon price, okay? So let's say from the previous example, Bank of America, it closed at 39 below the $40 strike that you did. What you could do in this case, you own 100 shares of BAC. You could then sell a covered call back at that same $40 strike price, and then you'll receive premium again and again from this, okay? So this is called the wheel strategy. You might see a lot of videos about the wheel strategy and options. Essentially, you start with cash secured put, and then if you get assigned that stock, you sell a covered call on the opposite end, okay? Russell or anyone else, any general questions on a covered call?
Not quite. So there's a couple of questions in the chat. I don't know if you want to wait until the end because they're still about puts, selling puts. So I don't know if you want to address them now.
Let's go over selling. Yeah, let me unshare. Let's get some questions in now.
Yeah.
Unshare it. I don't know how to unshare myself. I'll stop. Here we go.
There you
Okay.
go. Can you see the chat now?
All right, let's go to the chat. If anyone else that's watching in has any general questions, feel free to leave it in the chat right now. And there will be some time later on to go over any other questions. Let's look at 812. Mizu wrote, Sounds good so far, unless it drops back down to 30, but yay for even a deeper discount. It could be a deeper discount if you sold the cash secured put for that strike price of 30. There are situations where I do cash secured puts much lower than the current price. And then if I happen to get assigned on it, it's a huge discount and I'm happy for it. How do you determine, Sir Richie wrote, how do you determine which strike price to use when selling puts? I'm about to go over that in a little bit more detail. In general, I want to be the casino. I want to make bets that have a high probability of success. So I'm going to be picking strike prices that are pretty, what's called far out of the money.
Yeah.
So if a stock's at 40, I probably will sell a cash put at maybe 35 or so.
Yeah.
Well, there's a pretty low percentage chance that it'll go down to that 35 and then receive premium for it.
Oh, I just realized
Got a few more coming in.
we actually haven't said one of the most important things, which is about time decay, right? We haven't
Yeah, I'm
back
getting.
to you getting there, yeah. Cool.
Do we need to wait until expiry to close the trade? No, and I'm gonna go over why you usually don't want to wait until expiration. Remember, in all these transactions, you have a buy and a sell. So if you sell an option, you could always buy it back. And sometimes you could buy it back for less than you sold it at. And that's one of the main strategies that we actually focus on in our group. So the way I like to think about that, let's say you're running a store, you're selling your widgets, and let's say you get a good deal on the widgets, you're able to sell them at, let's say $50 a widget, but you got a good deal when you bought them and you could buy them at say $30 a widget. In this case, you would make the difference from 50 to 30. You would keep $20 per widget that you sold. And that is one of the main strategies that we do use. D Durham, how do you determine risk reward when considering buying calls versus selling puts? Buying a call is pretty rare for me because there's a fairly low probability of success on it, unless you're buying a call pretty far in the money. But the risk reward is something that I've been doing a lot of scientific data on to determine the best strike prices and the best premiums to receive based on certain conditions. So I can't quite give a quick answer to that one. All right, let me go over covered calls. Actually, yeah, here, how to determine the strike price. That was one of the other questions.
Yeah.
There are a lot of strike prices for most stocks, and I'm going to go over an example of one of the recommendations that we're giving to our group for tomorrow, and you'll get that one for free for watching right now. In many cases, you want to receive the premium, but not necessarily get a sign and buy the 100 shares. It's not the end of the world, remember, if you get assigned your 100 shares, because then you could sell your covered call in the opposite direction. But in general, I try to make trades where I don't want to get assigned too much. I don't necessarily mind it, but in general, I like to collect those premiums, have those little side bets in my casino coming in, and then make a difference. I don't think I was sharing, I'm sorry. All right, so how do we determine the strike price? A close approximation of the percent chance that an option will expire worthless, so the probabilities here, is called delta. This is one of the option Greeks, and delta is one of the most important Greeks because it tells us the percent chance, approximately, not exactly, that the option will expire worthless. So let's say a stock has a delta of 0.3. In this case, there's approximately a 30% chance the option will hit in the money, okay? Say a stock's at 40, you sell a cash secured put at a strike price of say 38. There might be a 30% chance that it goes lower than that 38, okay? That also means the opposite. If there's a 30% chance that it goes to that number, there'd be a 70% chance that it doesn't, and you keep your premium, okay? A lot of the trades I make, I want a delta of around 0.1 to 0.2. Most traders pick around 0.2 to 0.3 because you get a little bit of a good balance between the good premium and the risk that you might get assigned, okay? And the deltas, I'll show you how to look those up with a free resource really shortly. So this is one of the recommendations that I have for tomorrow. You might have heard of Churchill Capital, CCIV. They're making an electric vehicle, pretty high end, kind of competing with Tesla. Right now, in the end of close today, the stock ended at $24.28. Let's say that you want to make a bet, collect some money for this bet for July 30th. So it's only 10 days away, about 2 weeks. Remember, it's at 24.28. We want to make a situation where we're going to make some of that side money. We're that casino, we're taking those roulette bets. And we don't necessarily want to get assigned on it, because then we could get a good return on our money and then do it over and over again. So 24.28 is the strike price, is the current price. I'm recommending to members of the group to go to a strike price of $21. $21 is a 13.51% discount on the actual shares. For this position, if you decide to sell this as a cash secured put position, right now the bid price, the low price is $56. Remember, multiply by 100. And then the ask price is $62. You could usually get somewhere in between the bid and the ask. Right now, the middle's about $59 a share. So if you look at the return on this, let's say you get $60 for the position. You're going to divide that by the strike price. This is the amount of money you have to leave in your brokerage. You're leaving 2,100 as a percent. This would be a 2.86 or so percent return on your money in only 10 days time. That's a very good return on your money in general, as you'll see in compound interest calculators. Now, the delta that we mentioned before, the delta is actually the opposite of this, so 0.19, or there's an 81% chance that this put will expire worthless. What that means is there's an 81% chance the stock is not going to the $21 strike price. Okay. Are there any general questions on what I just showed with this particular strike or position?
Which website is this?
Okay, let's keep moving on. Go ahead. What website is this? Stockoptionschannel.com. It's
Oh,
a
yeah, it's at the front.
free website.
Yeah.
So stockoptionschannel.com. We can leave it in
I'll type
like
it
the post show notes. I'll leave links to these as well if you need. There's another website, the same as acquisition, optionsprofitcalculator.com. Remember, 24.27 current stock price. We're gonna sell a cash secured put, so we're writing it. That means you're selling the option for July 30th at $21 put. And here I put $59.60, so pretty close to it. This little chart here shows a graph on your percent gains that you would receive depending on the day and the share price. Green is good, red is not so good. This little line here is the current share price in between 24.20, 24.40. By the time we get to expiration on July 30th, you'll receive that full 2.9% or so premium for any price above 24.40. The price goes up, that's great, because we still get our 2.89%. The stock could go down all the way to the $21 strike price. You would still receive that full premium. And this 13.47 is the cushion. That's essentially how far out of the money you're able to go. So just looking at this, your stock could stay in a relatively tight range. It could shoot up. It could go down slightly. It could go down quite a bit. All of those situations, you would still receive your 2.9% return on your money. This is why we're the casino. We're taking these high probability bets that the stock price is not going to tank much lower than the current price. Okay. Now, 2.89% in 2 weeks. Some of you guys might see, oh, I can make 2.89% in an hour and I'm gonna be super wealthy. Sure, but are you able to do this over and over consistently and methodically like we're recommending? Maybe, maybe not. Let's say you have $10,000 and we're getting 2.8% every 2 weeks, okay? I'm gonna just round that off. Let's say 2.5 times 26 or so. There's 52 weeks in a year. 26 is half of them. You can make, say, 65% interest on your money if you're able to average 2.5% every 2 weeks. And so you're doing this with $10,000, you do it for 5 years, you're doing very well on your money, okay? We're the casino, we're taking a lot of these little bets. We're not just doing all in one position. I want to be playing roulette, I want to play blackjack, I want to play craps, all these games with this slight edge. And over time, you should benefit more than you lose, okay? That's all I have in my sharing part. Are there any other, we see we have a lot of questions here.
Yeah,
Let's
lots.
move up. All right, let's go to 8:19. Enzo wrote, let's say Apple's at 150 and I sold the put at 140 and it stays above that. You keep the whole premium. Yes, you collect your whole premium immediately when you make the position. If it expires worthless, you keep your premium, and then your money, 140 times 100, $14,000, you could use for another position over and over again. If Apple drops below 140, you don't necessarily, Enzo, you don't necessarily take a full loss there. You're just agreeing to buy 100 shares at 140, okay? You got a discount on your Apple stock instead of 150, you bought at 140, and you got paid premium for it. But yes, in the immediate term, let's say Apple's at 138, you might have a slight loss there that if you didn't do the position at all. But remember, we could always sell those covered calls, get that money back in the upside. And that's what Russell said at 8:19. There are tricks to avoid getting screwed on that. Enzo said your max loss is essentially 14,000. You are correct on that, but Apple would have to go completely bankrupt in order for this to happen, which is very, very rare. In order to sell this put, you need 14,000. Yes, you're right. It's called a cash secured put. There is stuff with margin that I'm not gonna have time to go over now, but you don't have to use a certain percent about it. Website, okay. Marion wrote, these aren't considered naked puts though. Cash secured, yes, cash secured puts and covered calls is all I recommend. I do not recommend doing naked calls where you don't own the shares. That could be extremely risky. Imagine if you sold a naked call on AMC when it was in the teens and it went up to 50, you'd be down a lot of money. Marion, the broker holds the cash from your balance to cover the price. Exactly. Dave wrote, I mostly do vertical spreads. Do you also do those? Occasionally, I just won't have time in this particular video to go over that, but I could in the future, Dave. D. Durham, to sum up the performance, can you estimate when account will be in 1 year based on average returns? Let me, D. Durham, at this point, let me go over my particular results for the year. If you join Theta Traders, you'll see all of these positions, and on the private Discord, these are every single option trade I made all year. It could be a little overwhelming, but I'll go over exactly what trade I make, date sold, date of expiration, what the current price is, what the strike price is, my premium collected, how much money that I brought in, and then my profit loss. What I recommend in most of my trades is a 4% per month return on your cash. So if it's a $25 stock, you want to get $100 in premium for it. Over here shows my monthly returns. total returns as well. I started a little bit lower because I wanted to make sure the strategy was very good. And then I steadily increased how much money I'm putting in. My goal is 4%, but you could actually buy to close these earlier and then possibly get higher percents. So these are my gains for every month of the year. And this is compared to the S&P. Fingers crossed, I've beat the S&P every month this year. Who knows if that'll happen again, but I'll take what I could get. Okay. William, on our brokerage account, we what sell the open? Yes, you sell to open a put. So let's say you wanted a stock with a strike price of 25, you would say sell to put, sorry, sell to open a put at 25 strike. You pick the month or date of expiration, and then you pick the premium received. Enzo, for using your gains, keep doing the strategy. Yep, that's all I'm doing. Keep using those money over and over again. I don't pull any of the profits that I have. I'm actually doing this all in a Roth IRA where I don't get taxed on any of the gains. That's a whole other side note with options. If you're doing it in a brokerage account, you'll have to pay short-term capital gains is pretty high, but I do it in a Roth IRA, so I don't pay any taxes. I already paid the taxes when I put it in. JND, if you have a cash account, it'll never let you sell puts that you don't have cash to cover if you lose. Good question, JND. You have to have enough money available. So if it's a $25 strike price, you have to have $2,500 in your cash. You can't have it in stocks unless you're super high net worth portfolio margin, but in general, you would have to leave that out. If you choose to sell a put in Webull, automatically, yes, if you're selling a put in Webull and you have the funds available, that is a cash secured put. Bert 888, do you provide recommendations for options to sell for lower accounts, 5 to 10? Yes, that is what I actually mostly do. Most of my stocks that I recommend are strike prices of around 3, which would only be $300, all the way to usually a max of 20 or so. But most of my positions are strike prices between 5 and 10 or so. So if you're doing a strike price of 10, that's $1,000. You could do this for 5 different positions like that, and you spread out your bets with the different games you have. Mariam takes your option. I'm trying to go quickly, so you only have 4 minutes to record. Takes your option buying power. Didn't actually take the full amount. You're right. All right. Are there any other general questions you guys have? I think we covered every general question so far. And Russell, you have anything to add?
No, I mean, this is annoying. I haven't upgraded to Zoom yet, so we only get 40 minutes total. So we only have 4 minutes left. But Lance is on Facebook, so make sure you guys just ask him directly on Facebook Messenger. Because I know this isn't long enough to cover such a complex topic. Like we haven't even touched on things like you know, rolling over and all this type of stuff. And maybe we can just do another one of these like, you know, tomorrow or the next day, you know. To cover all that stuff.
Yeah, no problem.
Yeah,
Let's let this sink in a bit for the beginners. Maybe we can meet sometime next week.
yeah,
Again, and
yeah,
I'll go over a little bit more on how I pick certain stocks, how I pick the strike prices, how I look for premiums and things like that.
yeah. That sounds good. And I think we've got time just to answer a couple more questions. So see if there's anything particularly useful.
Mizu wrote, after you get assigned, that's when you start selling calls at a higher strike than what you got assigned. You could do that, and I've been doing that quite a bit because you also receive capital gains. So for instance, let's say you get assigned on CCIV at the 21 strike for July 30th, August 1st, you could sell a covered call higher than 21. Let's say you could sell a covered call 23 or so. You would make $200 in capital gains as well as premium gains. And I do go over that. It's a little bit more advanced about what strike prices I pick for the covered call side of the wheel. William wrote, can we use CCIV for tomorrow to get your feet wet? I can't stop you, William. I think we gave it away. So yeah, get your feet wet here. Let's try it out. And send me a message on Facebook. And if you have any general questions on that position, we'll see how it goes in the next few weeks. I think it'll be a good situation. I can't stop you from doing it if you want to do it.
This is funny. There's
Which
more.
brokerage do I use?
Yeah.
I use, yeah. Jandy wrote which brokerage? I use Schwab. And there's a separate program called Street Smart Edge that gives us that delta that I was talking about with percentages. There's also a lot of other information. When I have time in a future video, I'll go over. And I use Street Smart Edge primarily through Schwab, but you can do this off almost any brokerage. Any of the main ones. You do need to get option approval. So you do need to do a quick application. Usually Webull, Robinhood, they'll approve you within minutes. Schwab, Fidelity, Vanguard, they usually take a little longer on it. Take some capital gains, 59. Yep, $59 off 2,100. And then just keep going over and over on it. Keep moving your money. I use 100% of my Roth IRA, by the way, into this position off my personal Roth IRA. Okay, Russell, we have about a minute left.
Yep.
I guess we want to find an ending point here.
Yeah, let's just wrap up there. So we have less than a minute. So make sure you reach out to Lance on Facebook. If you want to know more about the strategy, we've been posting about it in the Facebook group with this new ThetaTraders.com service that Lance and I have started together. Definitely check it out. It's basically on sale at like $150 for 3 months, which is ridiculous when you compare it to somebody like David Jaffe. In my opinion, I've done both. I've done Jaffe's strategy and Lance's. Lance is better. And it's a third of the cost or something ridiculous, maybe a fifth of the cost. So I definitely recommend it. It's what I'm doing. It's the only strategy I'm actually trading at the moment. So yeah, come and check us out and talk to us on Facebook more. And that's about it.
All right.
All right, guys.
Bye, everybody. Thanks for joining in.
Thanks. We'll talk to you.
Messages.
Talk to you soon. All right. Cheers, guys. Bye.